But today I'm going to speak about a new opportunity here at People's Capital Group for accredited investors only. And this is a Class A building we are purchasing off market for about a $4 to $5 million discount. The current owner developer owes about $22.5 million to the lender. We're buying it through the lender here. This is a 63 unit value add multifamily portfolio. It's actually three properties right next to each other in the Ironbound section of Newark. Seth and I have been investing in Newark, New Jersey for, boy, over a decade. The first property we bought together was a six family in Newark, New Jersey. We found through We Buy Houses sign. So we love Newark. We made our first million there. We've done very well for our investors in Newark, and it really is a city of a lot of opportunity if you know where to look and you know who to speak to get a great deal. And that's what we've done here. So let's dig into it. Quick disclaimer, this is not a solicitation of funds for non-accredited investors. Any investment decision cannot be made until you review the private placement memorandum in its entirety. By the way, the PPM and other investment documents will be ready in about 1 to 2 weeks. We already have about 23 soft reserves for this opportunity. So a lot of investor interest in this one. We'll also put a link here in the chat to complete a soft reserve if you feel like this is a fit for your investment goals. This is not an FDIC insured investment, no bank guarantee, may lose value, and past performance does not constitute future performance. So today we'll dig into our Fund 4 acquisition here, PCG Fund 4's building. We'll dig into the details, the structure, the financials. We'll talk about People's Capital Group and our executive summary, our investment thesis, why we focus on apartment buildings that are within a 90-minute commute to Manhattan. And we'll go over a couple case studies, some properties we're working on, some properties we've already sold as well, and wrap up here. This will be about a 1 hour, about a 45 to 50-minute presentation, and we'll leave time for questions thereafter. Okay, so since 2013, Seth Martinez and I, we've been helping investors and people build and preserve their wealth through bespoke real estate investment opportunities. We're strictly focused on the Northern New Jersey market here. We buy Class A, B, and C apartment buildings. And we've completed about 281 transactions together, Seth and I, here in New Jersey, about 83% reinvestment rate after a liquidity event. And we have about 113 private investors, mostly in the tri-state area, but all throughout the country as well. Right now, we are focused on acquiring this three property portfolio in Newark, New Jersey. All right, let's dig into the details here. So this is actually three properties right next to each other. I'll show you a map in the next few slides here as well. And these were just built. Okay, this portfolio was literally just finished. The building to the left here, 529-531 Mulberry Street, is a 15-unit apartment building with a small retail space in the ground floor. It's fully leased. It was finished in April. They got their C of O in April. The one in the middle, 526-532 Mulberry, is actually a refurbished warehouse. So that it was an older building and they completely redid it. They put in 28 luxury apartments, 17 parking spaces, and a gym in that building as well. Then 166-170 Emmett Street, the building on the right, that's a 19-unit apartment building. You can see it's right next to 526 Mulberry. It has 14 parking spaces as well. And all three buildings have an elevator also. So two of the buildings are brand new. One of them is a completely refurbished warehouse with all new appliances, of course, and fire safety and so on, and luxury apartments. The one in the middle, 526 Mulberry, was finished in March of last year. They got their C of O. The two on the right and the left here were finished in April of this year. They received their C of O. The developer is underwater to the lender, meaning he owes more money to the bank than the properties are worth. And in February, the lender hired and legally was able to have a receivership company, which is basically just a third-party management company, manage these assets. See, when a building goes into foreclosure in commercial real estate, generally the loan documents have wording that allows the lender to take control of the asset, to protect the asset. In this case, the management company got the buildings leased up. They're about 85% leased up in total. Rents are about 5% below market value. But they hire a management company to protect their asset through the process of foreclosure, because foreclosure takes 1 to 2 years, more like 2 years. So the properties don't fall into disrepair and mismanagement. They are able to do something called receivership. So essentially, the lender kind of has full control of the asset, but they didn't actually take back the asset. So the owner is being foreclosed on, but doesn't really manage the building. They're being managed by a professional management company. They're doing an okay job. I think we could do better, but they're doing okay. They are a professional management company at the end of the day. PCG fund, for example, here of an investment. So what would it look like if you were able to participate in this opportunity? This is for accredited investors only. Our minimum investment amount is $100,000, but we do accept in certain situations $50,000 minimum from first-time investors, and also are some current investors that maybe just don't have the full minimum of 100 right now at this time. So this property does have pretty strong distributions. It is a Class A building. We're going to finish that lease up, get it 100% leased up, bump the rents up that 5%, create multiple streams of revenue through storage in the basement, charging for the amenities and so on. We expect about 5% cash flow per year, and this is a 3-year exit. So on year 3, we plan to sell the asset, and that's where the majority of your return is realized. As you can see here, you'd expect about $5,000 a year for years 1 and 2 based on a $100,000 investment, and then about $146,000 upon the sale of the asset. That includes your return of principal and profit. So all said and done, it's about a 1.5, 1.6x equity multiple, depending on your investment size. There's 2 different share classes. We'll get into that in a second. So here's a new and proven approach to real estate here. The reason we focus on New Jersey is we've found that the Sun Belt and a lot of these more popular markets for syndicators are oversaturated. There is less limitation to buying and owning in those markets. Therefore, they become oversaturated because the real estate is built more quickly and there's more of it being built. So we've seen markets like Phoenix and Dallas, Fort Worth, and Florida, and even the Carolinas get oversaturated with a lot of inventory. And we try to focus on the North Jersey market where there's a lack of inventory. There's not enough real estate here. I know it looks like we're building a lot, but we are about 3,000 to 6,000 units short each year. If you were at our client appreciation party in November, you would have known from my presentation that we are very short on how much real estate we're creating each year here in New Jersey, and it's expected to be even shorter, even more of a deficit of inventory to demand into 2026. So we buy these properties that have value add potential. Usually we're doing pretty heavy value add. We just bought a 42 unit in Passaic. We're putting $2 million into $1 million into the building. We're turning over majority of the asset. We're putting $30,000, $40,000 into the units. This is a very different building. It's not a vintage apartment building. Again, they were just completed. They're brand new. It's really a management play. We're going to be sprucing up the units as they turn over, but really bumping up the rents to 5%. It's a new building, no rent control for the asset. And then also it is not completely leased. So there's about 15% vacancy, and we'll also put in those storage units, create additional revenue streams there. There's 2 huge basements, about 60 storage units in there. Hands-on property management. We are vertically integrated with in-house property management, and we're supplying an underserved market here by buying buildings within a 90-minute commute to Manhattan. And this building will allow you to commute to Manhattan in about 30 minutes. We are able to really offer service to a market that is underserved, and there is more demand than there is supply. So at this time now, we're entering into a purchase agreement as we finalize our PSA. At this time, we have a accepted LOI at 18.5 million, about 4 million less than what is owed to the lender. There's a tax abatement in place until 2030, so 0% taxes in just land taxes in 2026. Then it goes to 20%, then 40, then 60, then 80 over the next 5 years. That helps with that cash flow there as well. Light value add strategy, refresh the common areas, add storage lockers, implement fees for various amenities like the gym, bring rents to market. 63 units. There's 62 apartments, one little storefront, $1.6 million current rent roll. Our pro forma rent roll is about 2 million. We assume about 2.5% rent growth per year, 39 parking spaces as well. We're looking at about 22% rent increase, mainly by filling up those vacant units over the time we own the asset, over the 3 years we own the asset. And by the end of year 3, we're expecting to sell it at about a 6% cap rate on the exit. It's about a $24 million exit. Project level, 25.8 IRR, 1.7 equity multiple. That's the project level returns. We'll go into the net to LP shortly. Here's a map of the assets. You can see 529 Mulberry is actually right across the street. There's Mulberry Street. And then you have 526 Mulberry. That's the refurbished warehouse. And then you have 166 Emmett right here, which is another brand new asset. So 166 Emmett's brand new. 529 Mulberry is brand new. 526 Mulberry is the refurbished warehouse with luxury units there. There's the where the portfolio is located right there in South Ironbound, 16-minute drive to Manhattan. It depends if you took what type of transportation. If you drive 5 minutes to Newark Penn and jump on the PATH train, it would be about a 5-minute drive and then a 18-minute PATH ride into the city. If you jumped on one of the buses, it would take longer because you take the bus and or you could take the bus to the PATH station in downtown Newark. Newark Airport is about 2 miles away as well. Here's some photographs. Beautiful brand new construction apartments, open layouts. All units have condo level finishes, stainless steel appliances, equipped with kitchens with dishwashers, and most of the 2 new buildings have keyless entry systems as well. There's the big, large, one of the large basements. There's actually even a larger one over to the left there. We're going to put 60 storage units in between 2 large basements. We'll lease those to the tenants in the building and the general public as well. There to the right is your gym. Right now, they're not charging for the gym. We feel we could probably charge a $20 a month amenity fee. They also don't have it open to all 3 buildings. They only have it open to the middle building since it's in the basement of the middle building. So we'll open it up to all 3 buildings. We'll ask for a $20 amenity fee. We assume maybe about 60% of the tenants or so will pay that. It's not a very large amenity fee, but just create additional forms of revenue there through those 2 strategies. And let's not forget about the tax benefits of real estate. A $100,000 investment can produce about a $50,000 paper loss or tax deduction in 2026 for your passive gains. So about a 50% write-off in 2026 here. So if you have passive gains expected for 2026, you can invest in this opportunity and get a large paper write-off through accelerated bonus depreciation on this property. We are closing in 2026, so this will be for your 2026 taxes. Even if you invest in 25, the tax benefit is given in the year we close on the asset, which will be Q1 or so of 2026. And we expect to do that cost segregation study and get about $2.8 million in tax benefits here on this asset, tax depreciation up front. Again, if we have any questions as we go along, feel free to put them in the chat. I'll answer all questions at the end here. And all right, so here's our structure. We have 2 share classes. Our minimum $50,000 or $100,000 for the B share class. That's a 7% preferred rate of return. Our minimum, oh, that's a little typo there. It's actually $1 million for the C share class. That's an 8% preferred rate of return. And then there's a difference in the equity split here is 70-30 for the B class, 80-20 for the C class. So obviously there's an incentive for the larger investment amount. We'll be taking on a bridge loan of about $15.5 million for this asset. Since it doesn't have a good trailing 12, meaning it's really just in the lease up phase. So a lot of the tenants have moved in essentially since April when they got the C of O for the 2 new buildings. It doesn't have a great T12, so wouldn't qualify for agency debt. Now, the bridge debt market is really interesting right now. We're actually getting quotes about 300 bips above SOFR, about 7% or so for about 85% of the 84% of the purchase price. So we're working on that right now, finalizing our debt. It's about a 5.3 LP equity raise. We'll bring in another 300,000 or so ourselves as well, and about $21.1 million project cost. Our net IRR to investors, we're targeting 16.6 for the B class, the smaller investment, 18% IRR target. Net to LPs for the better share class, the C class. Net equity multiple about 1.57 for the lower investment, 1.62 for the larger investment. Net average annualized return, that's essentially your annualized cash on cash return, taking into account the sale proceeds and the cash flow, is 18.9 for the lower investment and 20.8 for the larger investment. And of course, both investment share classes enjoy that 50% tax depreciation for 2026. So if you have a large passive gain coming in 2026, this is a great way to write it off. If you don't, you can roll the tax benefits over into 27 and so on. The transaction is expected to close probably February to March of 2026 here. Here's our numbers on the right. We can send you our underwriting spreadsheet if you'd like. We're an open book. We can also send you this deck if you'd like as well. This will go up in the investor portal. If you haven't gotten access to our investor portal, I'll put a link in the chat here at the end of the presentation to get access to our portal. We'll upload this presentation to the portal there, the recording of the webinar here, and also the deck itself. You can kind of go through those numbers, but you can see here our sources and uses on the right, and those are how the numbers are broken out. Here's our net operating income projections. Again, I'm not really going to dig into this right now. We're very conservative with our underwriting. We really have a lot more costs than the seller is showing. We have a lot of assumptions that the seller either doesn't disclose or doesn't, I guess, have on his books right now. So we have a pretty aggressive or conservative expenses and expense ratio on this asset. One of the beautiful things about this is how low the taxes are. Now they will grow through time here, but we are really enjoying some very low taxes on the asset for, especially the first year and two here. Yield on cost starts at 6, and we grow that up to about 6.8, 6.9 towards the end of the project. Here's our annual cash flow projections. So we're looking at, we'll also have some additional reserves to distribute as well. 4 to 5% cash flow in years 1 and 2. We have our total equity return there, our gross profit, and our levered and unlevered returns as well. Of course, we'll focus on levered returns because we will be using debt to acquire this asset. Here's some rent comps. We felt the best rent comps of the property itself. Now, if you go into our investor portal and you click on the due diligence folder, you can go into, that'll bring you into like another subset of like 8 more folders that will bring you to all different rent comps. So you can click into our due diligence folder and you can go through all of our rent comps. We have additional rent comps for South Ironbound. We have other rent comps for all of Newark. We have sale comps as well. But in my opinion, the best rent comps is the building itself. What is this building already getting? And this is what the building is already getting. We assume we'll just continue to get what the building is getting. I think we have a better management company and a better leasing team, but let's be honest, the market is what the market is. So we'll hopefully get a little bit more, but in reality, we're just pricing it out, assuming we're kind of already getting what the market is bearing here. So we do assume rent growth of about 2.5% a year, but these buildings are already leasing pretty nicely. They have big floor-to-ceiling windows in the 2 new buildings, and 526 Mulberry also has very open floor plan as well. Open floor plan really for all these brand new assets here. Let's talk about fees to GP. So we do charge a 2% acquisition fee that's rolled into the deal. That's about $298,000. We have an AUM fee that's about 2% of gross collected income. So we have to do our job, collect the rent, get the revenue coming in to earn that fee. Property management fee, same thing. That's 3% of EGI. And property management for us is not a profit center. We normally need to hire someone additional whenever we buy a building like this. So generally, that $51,000 a year or so we're earning is going right to additional payroll. And in equity placement, we share this with any equity placement companies, introductory fees from other investors or third-party broker dealers. That's 3% of capital raise. This is all worked into the deal. The net returns to LP are what they are, taking into account these fees here. Couple disclosures. Some distributions are a return of capital. We'll have additional reserves that we distribute back to investors to make sure we achieve those distribution goals. All distributions will be considered a return of capital to help you with your tax benefits. If you want more explanation on that, we could set up a call. We work with a third-party leasing team, one of the best broker teams in the state here that is used to actually leasing up 0% occupied brand new Class A buildings to 100% occupied. So they'll do great with this. Their fee is the first month's rent, but they handle all marketing fees and advertising fees as well. And the property is expected to have a negative cash flow for a good part of the first year. So we'll be actually just having additional reserves to distribute back to investors for that first year to make sure that we're achieving our distribution goals for this project. So with this asset here, here's our debt structure, about $15.5 million loan. That's about 73.5% of the total project. We're working on locking in that 7% interest rate, about 84% LTC or so. 3-year loan. We plan to sell after 3 years. Interest-only payments for those 3 years as well. There's our net operating income. There's our excess cash flow after debt service. Starts about a 1.17 debt service coverage ratio and should grow to about a little over 1.3 as we stabilize the asset. So we will be able to cover our debt service, but we do have to get those units leased up, that 15% in the building there. So initially they were asking $20.5 million for this deal. I was negotiating with the lender in February, so beginning of this year. And I offered them about 18.3. They came back at 20.5 million. I said, good luck. And then about 2 months ago, they came back and said, hey, we'll lower our acceptance offer to 18.7. I got them down to 18.5. So, that's how a lot of these deals are done. The initial negotiations don't get you anywhere, but then after that, we are able to normally get them. A lot of times time is on our side. We are negotiating directly with the lender and acquiring the asset through the lender, and the receivership company, the management company, is managing the asset and leasing up those units. Hopefully there's more units leased by the time we actually close. I think there will be because they're working diligently to lease up that remaining 15%. So with a little luck, we'll actually be buying a more stabilized asset by the time we close on this. Our going in cap rate is 4.8. The reason our going in cap rate is a little bit low is because it has 15% vacancy. Rent's about 5% below market value. So there is some real value add to this property. Our stabilized yield on cost, once you lease up all the units and bump the rents up that 5%, is 6.8%. Our reposition to cash on cash, about 4.1%. Here's our exit assumptions. We assume the market is what it is today when we go to exit. We assume a 6% cap rate on the exit. We assume about $383 per unit per door. That after closing costs, about 23.5 million proceeds from sale, before paying debt service, debt principal. And we assume about 2.5% rent growth per year. Obviously, we'll do our other streams of income, the storage in the basement, so on. But we don't assume the market gets better. We do not assume cap rates compress. We do not assume interest rates lower and cap rates compress. Now, personally, I think that will happen over the next 3 years, but that would just be icing on the cake. Here's our hard costs. Very little, very little. We're not doing much here. These buildings were just built. The biggest cost is the storage units, 60 units at 1,300 per unit. There's already a nice floor there with nice lighting. There's some units we need to make ready. We assume turnover of some units we're going to be increasing rents on and so on. Very light, paint, lock change, clean, 3,500 a unit. There's some vacant units, about 9 vacant units. Again, lock change, clean them. We don't even really need to do that. We're just going to have that additional money in the budget. It can't hurt to have that in there. They're already clean. Locks already changed. They're ready to go. We're just going to have our leasing team lease them. So about $174,000 in hard costs here. Clean out the basement, getting ready for the storage units. That's the biggest cost there. Here's our timeline. So we have our soft reserve period now. Which will remain for the next few weeks or so. Our PPM will be issued in about 2 weeks or so. So our eDocs will be ready to be signed, and capital will be ready to be committed in the next 2 to 3 weeks. It's always hard with the holidays. Things kind of slow down, but ideally by the middle of this month, our PPM will be ready. Our bank account will be open. We'll be accepting capital. At this time, we're accepting soft reserves. We have about 23 soft reserves right now. I haven't checked the website today, but they're coming in every day. And a soft reserve means you have a spot in the deal. It's not legally binding, but you have a spot in the deal. Then once the PPM is issued, there'll be about a 30-day window to convert that soft reserve into a hard investment. So you would log on to back onto the investor portal, sign the eDocs, wire the capital, and of course, get it, approved as an accredited investor on the platform as well, which is pretty straightforward. Talk about that at the end here. And the deadline to do that is January 15th. Okay. If you're investing through a self-directed IRA, you want to get moving on that. As soon as the PPM is ready, you want to send that to your IRA custodian. It's going to take them about a week to review. They're going to come back with a couple documents you have to sign, a couple documents we have to sign, and it takes them usually another week to actually facilitate the investment. And then with the holidays and everything, throw another week on top. So it's about a 3-week process to actually complete the investment for a self-directed IRA. So I wouldn't wait until, January 10th to start having your IRA custodian review the investment, because if January 15th comes and goes, then we reach out to the investors on the wait list and we start filling those spots for investors that have not completed their investment. Our due diligence, we plan to complete by January 30th, plan to have our mortgage commitment by February 15th, and closing by March 15th conservatively. Now we just a little note here. We do keep the funds in a high interest savings account. So we actually start distributions pretty quickly here. Funds invested in December will have a small distribution in end of January. It's not going to be very much depending on how long it sat there, but we earn about a 3.8% interest rate on a money market account with PNC. So, the funds that are invested as they sit in the account prior to closing, those are earning interest, and we'll distribute that interest. Distributions are going to be monthly on this. That's something new we're doing. We normally do quarterly distributions. I'll repeat that. For our current investors on the webinar, you're jumping for joy. Monthly distributions, all right, instead of quarterly. We the people have asked for it. We have given it. So that is what we'll be doing on this opportunity here. 50% tax depreciation for the 2026 tax year. So your K1 you get in March of 27 will show that big tax write-off, which is about 50% of your investment amount. You can roll that into future years as well to write off future passive gains. By January of 28, we expect to stabilize the asset. By May of 29, we expect to sell the asset. This is about a 3-year investment. All right, I'm gonna hand this off to Seth Martinez now, the second owner of People's Capital Group, my second half here. Seth Martinez and I started People's Capital Group in 2013. He's gonna go through a little history here with us, and then he'll hand it back to me.
All right. Thank you, Aaron. Okay, so my name is Seth Martinez. You probably know who I am. If you don't, I'm the other founder of People's Capital Group. And I just want to give you about, I'm going to go quick, but we have about 10 slides here and just give you some background about the company that Aaron has not spoken about yet. I'd like to start with the overview. Who is People's Capital Group? Why is People's Capital Group? Meaning, why are we in business? What are we trying to accomplish? And basically, the answers to those questions are we are a real estate investment company, but we want to set high standards. We want to be the best in the business. That means offer two things. One is the best housing within the market that we're in, and we want to offer the best investor experience to our clients. And over the last 10, 12 years, we've measured it, and we do see a lot of signs that we're moving in that direction, whether it means looking at competitive housing units such as kitchens, bathrooms, flooring, fit and finish, and so forth. Also interviewing our tenants and also comparing that to what's on the market. And there's the same thing with our other clients, which is our investors, and looking at competing real estate companies and asking the people that invested with those companies what types of returns and experiences they've had and comparing that to what we have. And we feel like we're on the right track and we're offering a very high standard of service. So that's good. And we want to keep getting better. We never want to rest on our laurels. And again, we want to set the highest standard in the business. Okay, so we're also vertically integrated here, as it says. We have about 12 years of experience, and we comes with a lot of market expertise, and that helps us accomplish these goals. So what I'd like to do is go to the next slide. And okay. So past performance, what have we accomplished? You know, talk is cheap in this business, really in any business. It's really more important to say, okay, well, what have you done? So what we have done is we've completed 11 syndications. We've also done a lot of in-house deals without investors. But with the investors that we have worked with, we've completed 11 deals over the last 12 years. Average rent roll has increased about 8.6%. The average annualized cash on cash return for these deals has been about 13.8%. And the investor reinvestment rate, which is a good sign and good indicator as to the experiences that our clients and our investors are getting, is pretty good. It's at 83%. Okay, so on the next slide, we're going to talk about sort of the numbers history of People's Capital Group a little more broadly. So we have assets under management of just under 40 million. It's mostly New Jersey, as Aaron said. We have one condo in Philadelphia. We've invested a little bit in Vermont in the past as well, but we're really focused on New Jersey. We have very good relationships with contractors, with attorneys, and we know the market very well. So we want to stay focused in this area. We have 200 apartments that we're leasing out right now. And the monthly rent roll is around 300,000 or 3.6 million in rents per year right now. We are vertically integrated, as Aaron said, meaning we have management in-house. So instead of having to hire outside management and not being sure exactly how they're doing things and where they might be at certain times, everything's in-house. So we know exactly what's going on, and it can help us. It does help us produce better results and manage the buildings more efficiently. We have 30 years experience between me and Aaron. There's 12 people on our team, both full-time, part-time, and 1099. And then lastly, just again, as I said, there's been about 11 or 12 completed syndications. We've raised about $18.6 million in investor capital over the last 12 years. We are looking to increase that. We're looking to open up more opportunities for qualified investors. And we have returned 8.4 million in investor capital to date. Okay, so current portfolio highlights. The current numbers, we have 33 properties, everything from single family and duplex properties all the way up to 20, 30, and 40 unit buildings. Total unit count, total doors are 200, as I said. Our occupancy rate, again, having management in-house, we can really extract maximum value and operate very efficiently. So we're at 99% occupancy rate. Our average cost per door is $131,000. Average rental rate, $1,527 a month. And the average realized sale per door has been $226,000. Okay. And then what's in it for our customers? Again, aside from our tenants, which is one of our customers, we want to offer great housing. But for our investor clients, We want to offer them the opportunity to preserve their wealth and build their wealth through real estate. Not all their wealth. We often recommend about half, 25% to a little over half, depending on the individual and what their goals are. But we want to offer an opportunity to have confidence in investing in real estate and preserving that capital and growing that capital and creating a good return on investment. So we're going to talk a little bit about how we do that. In this slide here, we do operate in an area of New Jersey that's sort of underserved. It's not the very low end, and it's not the 500 unit, $500 million buildings either. So we're sort of in a niche that allows us to find great deals like the one Aaron described earlier. And again, it might be too small for the larger investors, too big for the smaller investors. So we can come in and find great deals and create great opportunities for people to invest in those deals. And again, we leverage an extensive network of realtors, landlords, just relationships, attorneys, and that allows us to get these deals kind of off market as well. And then being vertically integrated, again, it just gives us a chance to be very efficient in operating, in moving quickly, getting the deals, turning them over, and managing them very efficiently. And again, investor first approach. So we want to provide a great experience for our clients and not just give them the assurances and the confidence that their money is in good hands, but that it's being managed as efficiently as possible. Okay, on this slide, I'm going to hand it off to Aaron, and then I'll resume on the next slide.
Thank you, Seth. You caught me mid-bite here. We're multitaskers here at PCG. We could do webinars and eat lunch all at the same time. All right, so let's talk about the deal process. We will look at 100 deals to buy one. But we also want to be efficient with our time and our resources. We have a very in-depth underwriting team. These guys used to underwrite for UBS. They're used to underwriting $100 million deals. We have very in-depth underwriting models. If you want a copy of that, you can schedule a call with a member of our team or email us as well at info@peoplescapitalgroup.com. And so out of those 100, we'll put about 30 into serious due diligence and have our underwriting team really underwrite them, pull comps, put together the whole in-depth model, all the numbers, all the due diligence. And then we'll submit about 10 to 20 LOIs or offers. And out of those, about one gets accepted. Quite frankly, if more than 1 out of 20 gets accepted, you might be offering too much for your real estate. Then we engage subject matter experts for deeper due diligence once we place it under contract. Our data room is compiled with offering documents, full due diligence set. That's you can access now. I'll put that link in the chat here at the end of the presentation. You can also schedule a call with a member of our team. They can get you into the data room. Our subscription agreements and PPMs and investment documents are put on the platform as well for investors to review and execute. After we close, we do monthly cash distributions. We do quarterly and monthly updates. Our updates are very in-depth. I send pictures of what we're doing, renovations. I send numbers. I send breakdown unit by unit, how we're doing with leasing, renovations, and so on. I send breakdown of how much we're investing in each unit and what that means, how much more rent we're getting, how much more value does that add to the property, how much more net value, the cost of renovation minus the gross value increase. Quarterly financials are done. That's a balance sheet, profit and loss statement, distribution statement. That's sent out on a quarterly basis. Annual K1s are sent out. We try to get them out by March 1st. We try to be very quick with our K1s and our tax forms each year. We know how important it is to get those K1s out to you quickly. And we have an in-house bookkeeping staff that takes care of that for you. And all this is uploaded into your investor portal where you can access it anytime, 24/7. It's also emailed to you as well. Distributions are generally done through ACH deposit. We prefer that so we don't have to go chase checks. You don't have to chase checks. It's deposited right to your account on this deal on a monthly basis. And I'm going to hand it back to Seth here. This is more his department. He's managing the management company and the staff and everything, so he can break this down for you.
Okay, great. Thanks, Aaron. Yes, so the company is set up in sort of two parts. We have Aaron handles the investors, the marketing and the branding of the company and client relations, and he has a team of about 5 people. Matt, Patrick, but there's also Christopher, Amika, Mohammed. There's Matthew in New York with UBS, or formerly from UBS. He helps us with the underwriting. He's been trained and has a lot of experience with the underwriting of these deals. And then in the other side of the company, we have the property management team, the operations, which is includes the property management team, and I oversee those teams with it's about 6 or 7 of us, and includes everything from property management, bookkeeping, accounting, construction, the contractors, attorneys. We have about 5 or 6 different attorneys, one specialized for each part of real estate, such as landlord tenant, such as real estate closings, commercial, real estate closings, residential, affordable housing, litigation, which is rare, but can happen. So we're compartmentalized. We try to be very organized, and we're always looking to improve the process. But this is the general layout of the company. And then lastly, on the next slide, you might already know about us, and in particular, me and Aaron. But Aaron, if you could change that slide. Okay, so this is just a summary. I'm going to leave everybody here. You might already know our history, but Aaron and I, we started working together about 12 years ago because we had the same vision. We wanted to build wealth for ourselves and for the people we work with. And we really learned that the more we can help other people who have the similar vision as us to build wealth in real estate, the more we can help ourselves and create great housing too. So it's a win-win-win all around. And so it's worked out well, and we're looking to take our business and our investor experiences to the next level over the next 10, 12 years. And I'm going to hand it back to Aaron now. Thank you all for listening to this part of the webinar.
Thank you, Seth. Excellent.
Sure.
All right. Let's dig into our investment thesis here. Why we focus on apartment buildings in New Jersey here, and why we're buying this particular property portfolio. There's a nice picture of the Prudential Center in downtown Newark. All right, so we see in New Jersey, as I was saying earlier, we have a shortage of housing. We really have a housing crisis, as you see in lots of cities in America, but especially in New Jersey here. People say, why do you invest in a blue state? We actually know how to navigate a lot of the restrictions in this state, but also it is harder to build in New Jersey because it's a blue state. There's more restrictions. There's more red tape. What that means is it's less likely to be an oversaturated market. Markets like Phoenix, Houston, Florida, these markets are easier to build in. They're red states. There's less restrictions. What that means is more inventory hits the market faster. What that leads to is more of a boom and bust of oversupply, then, supply slows down, and then there's undersupply, then oversupply. In New Jersey, it's more of a steady grind of consistent supply and demand imbalance. There's also aggressive capital appreciation, consistent demand here, strong rent demand as well. And there's a never-ending flow of people that need to live within about an hour commute to Manhattan here in New Jersey. Jersey City is now called the sixth borough by many. So it's really becoming, quite frankly, to commute into Manhattan from downtown Newark, you can jump on the PATH train. It's an 18-minute train ride, and you're in Penn Station. If you live in parts of Queens or Brooklyn or Bronx or Staten Island, it takes longer to commute into Manhattan than it does from downtown Newark. So a lot of people are recognizing that, and they're moving to areas like Newark, Jersey City, Bayonne, and so on, where we own assets. Home ownership costs is through the roof. We already know that. Interest rates have really caused it to be much more expensive to own a home, and residential prices just continue to grow. They're still growing. Everyone thought they would lower with higher rates, but they're continuing to grow. It is about 33% more to own a home in New Jersey than it is to rent. So I think rent has room to grow. I think with the lack of inventory coming on the market, the lack of building, we're going to see rents continue to grow, although we don't really underwrite aggressive rent growth in our underwriting. It is much more expensive to own a home than rent. So what are people doing? It's a generation of renters. A lot of people are just settling in for the long haul as a renter, and that's good for us landlords who have those rental properties available, especially like these nice Class A type of units that are nice to live in, enjoyable with parking and so on. Also, here's the average monthly multifamily rent versus the new home mortgage payment in New Jersey. As you could see, it used to be cheaper to own a home, and then around the end of 21, it became much more expensive to own than rent. And as I was saying, more and more people are going with rentals, long term, especially. Here's some numbers, a quick snapshot. We had about 16,000, a little over 16,000 units um, of inventory hit the market here during the last 4 quarters. We had 19,000 net absorption. So we're short about 3,000 units here. Rent's gone up about 3% year over year. Occupancy's gone up 60 bips, 96.8% occupancy throughout New Jersey, one of the highest occupancy rates for a state. New Jersey often ranks in the top 3 for occupancy and often rent growth as well. Employment's gone up 1.1%. So we're continuing to have quality jobs here. These are quality blue collar, white collar jobs and blue collar jobs as well throughout the state. A lot of Fortune 500 companies are here, a lot of pharmaceutical companies, and so on. uh Households are up. Despite what you might read in the media, there are more households in New Jersey every single year. We are having net migration into the state, so we're building every year. um about 9,100 units more households this year. Okay, let's go next slide here. Declining homeownership rates, kind of touched on that, pretty much maxed out in 2005 at 70% homeownership rates throughout the New Jersey here. And now we're down to 62.9% in 2024. We'll get more data at the end of 25 here on this. But unfortunately, it is just so expensive to own a home. It's a declining, serious decline in homeownership rates. Here's our supply growth per metro. As I was saying, some of these metros have a ridiculous amount of supply coming to market. Austin, 7.3%. That's a lot. Charlotte, 6.2. Nashville, 6.1. Phoenix, 6.1. Phoenix is hurting. There's way too much supply. Hit the market way too fast. Um, and you can see here, New York City is all the way down to the bottom at 3.7. That's a more healthy amount of supply to hit the market. But most of these are smile states, right? And there's just so much supply coming to market so quickly that oversaturates the market. And we don't see that really here in New Jersey because it is so much harder to build. Okay, let's get into some case studies here. Again, any questions, put them in the chat as we go along. Here's an 11-unit building. We plan to refinance over 5 years. We actually refinanced it about 2.1 years in. We were able to get about a 27% annualized return to investors on that refinance. Now it's on the market to sell, and we expect to achieve higher than targeted returns to our investors on this opportunity. This was in Paterson, New Jersey. Here's a 6 unit. We refinanced it successfully, achieving about a 13.9% annualized real return to investors on this building after about 3.2 years. We refinanced it, and this was in Passaic, New Jersey. Then we went and sold the building a few years later. We held it for 5.6 years in total. We realized a little bit above target returns to investors. We got 11.7% annualized cash and cash return to investors. We were targeting about 11% on this asset. Here's the 42-unit we bought in Passaic, New Jersey last December. We've distributed every single quarter. We distributed cash flow to investors on this. We are on target. We distributed about $50,000 back to investors on this building. Bought it for $7.6 million. We have $1 million renovation budget. We plan to refinance this in about 2.5 years or so, and then sell it around the end of year 5. This was a $4.1 million equity raise, total 5-year investment, 42 apartments, and we had about, I want to say 16 investors or so participate in that opportunity. Actually, more than that. I think almost close to 20. In this building in Bayonne, New Jersey, we had about 42 investors participate in this building. And, we like to be fully transparent. This is a beautiful asset, but we've run into a lot of challenges on this building. We've gotten delays from the town, but we were able to install all new mini split HVAC units throughout the building. So we reduced about $21,000 in heating costs to our bottom line there by putting in mini splits throughout the entire building. and now the tenants pay their own heat, and now they have AC as well. So we're kind of converting this from like a B minus into a B plus, about a $622,000 renovation budget. We've increased the rent roll 18.6%. The project's on schedule, but it is slightly over budget, and we're working hard to get this property sold over the next 2 years or so. This is PCG Fund 1. The last building was PCG Fund 3. So there's just a note here. PCG Fund 2 is a debt fund where investors invest and earn a quarterly interest payment between 8 to 10%. And we fix and flip properties with that debt fund as well. So we'll do about 9 to 10 projects a year with the debt fund. We'll buy land. We'll get it approved for sale. We'll sell it to a builder. We'll buy small multis and reposition them and refinance out. We'll buy single family fix and flips and flip those. That's what we do with the debt fund, and we have investors participate in that debt fund who like the stable return of lending. They're lenders, so they just we sign a promissory note, they get a interest payment, and then the principal's returned over a period of time based on that promissory note. It's a loan to the debt fund. Here's a 25 condo unit building in Paterson, New Jersey. We're actually going to be selling this this coming year, hopefully Q1 or Q2 of next year. We've increased the rent roll by 26.2%, probably even more than that at this point. And we are on track to achieve target returns to investors through the sale of this asset over the next 6 months or so. This is a 27-unit apartment building in Rahway, New Jersey. This is an interesting play. We bought this as a boarding house. We're now finalizing the rezoning of it into apartment buildings. We renovated a lot of the units in this building. We've done a very good job with it. The rent rolls increase almost 68% since acquisition. Our cash flow is on budget and on target. Our project's ahead of schedule and on budget. We're ready to refinance this property in 2026, and we expect to either achieve or overachieve target returns to investors through this refinance. This is right near the kind of downtown area in Rahway, New Jersey. If you don't know much about Rahway, check it out. It's a great market to invest in. Here's the transaction Seth and I have completed here over the last 12, 13 years together. Seth and I started this company in 2013. We've completed over 100 transactions in Newark, New Jersey alone. That's where this property is located. Newark is our specialty. We've done a lot of transactions there, 197 transactions in Essex County, which is the county that holds Newark. And really even more than what we show here. Together, we've completed a little over 280 transactions together all throughout, mostly northern New Jersey, a couple spots in southern New Jersey there as well through the years. But for the most part, we're very active within that, 60 to 90-minute commute to Manhattan there in northern New Jersey. Here's a summary of all the buildings we've syndicated. That means we've raised capital from outside investors and filed with the SEC. We have an average annualized return of full cycle deals at 11.9. We achieved about a 24% or so return on that refinance there as well. And we have another half a dozen assets that we are in the process of repositioning, getting ready to sell or refinance them over the next couple years. So that's it for this presentation here. I'm going to now answer questions, and I'll also put a link in the chat to get into our investor portal. There's already a link in the chat to schedule a call with a member of our team. We talked about how these buildings were just built and stabilized. It's a really interesting time in this market where you can buy a building where $22.5 million is owed to the lender, and the investor, the developer, probably put in more of his own money as well, maybe another million or two on top of that. So here's a $24 million asset, and we're buying it for $18.5 million. It's 85% leased up. Rents are only 5% below market value. Very light renovation strategy, very light value add strategy here on this building. And that limits our risk for investors as well. So we've already had 23 soft reserves in this opportunity. We're going to run out of spots pretty soon. We have a number of family offices interested in investing as well. Once they commit to the investment, all the spots should be filled up. If you are serious about investing in this opportunity, building your wealth, and you're an accredited investor, click the link in the chat to schedule a call with a member of our team, or you can email us or go to peoplescapitalgroup.com. I'll also put a link in the chat to go to the investor portal and complete your soft reserve now. We are running out of spots. Again, we have 23 soft reserves, multiple family offices, and we're doing about a $5.3 million raise on this, so we're going to run out over the next week or so. Then our PPM will be ready, and you'll have about a 30-day window to complete the investment. So that's it for me here with Aaron Fragnito. I'm going to answer your questions now, and I'll put that link in the chat as well to complete that soft reserve.